This fund invests in high-quality companies, mostly from the UK, loaning them money essentially by buying their bonds, hoping to make a very good income from those bonds and possibly also a capital gain on top of that income. The investment process is quite unusual. Firstly, we focus on our 100 favourite companies. That makes us very different to our competition, who often invest in thousands of companies. We focus on what we consider to be the 100 best opportunities. We use a special quant tool to look at the volatility of each of these positions. And what that really means is we're trying to provide a smoother income profile and a smoother total return profile for our fund compared to competitors. So we spend a lot of time focusing on what's called downside risk or volatility protection on top of income and capital gains generation. Generally speaking, high-quality corporate debt is regarded as being lower risk than many other investments, but there are still some risks to be aware of. Because these are bonds, also known as fixed income, they can suffer when we have high periods of inflation, like we did after COVID, for example. So we have to manage something called interest rate risk in that environment. We have to dial that down. And at other times, if the economy is going through a recession, for example, we might have to dial down the credit risk in the fund. That means buying higher quality companies that are less cyclical or have less volatile earnings. ESG we see as being very important because it helps us avoid what we call the losers. It helps us avoid companies that may have significant problems in the future. And if we identify those ESG weaknesses early, we can not invest in those companies or exit those companies before those issues become a significant problem. The problem we have with bonds is there is very little ESG data available from public sources. So we have to speak to companies ourselves, ask them detailed questions, and then score them from an ESG perspective on our own behalf. And that takes a lot of time, and it's one of the other reasons why we limit this fund to 100 companies maximum. I would say very much like I own it myself. I own it entirely in my SIP, that's my long-dated savings pool. Because these bonds are typically low risk but provide a nice income over the medium term, I like to have that safety and that security of solid returns over the medium term.